Good evening, sir.
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 Guys, relax.
Okay.
Start, sir. Sorry.
Okay, fine. We'll start. Okay, right. Now, today's session, we are focusing on those 5 chapters that we have discussed already, right? Except branch accounting. The other 5 chapters that we have already learned in Group 1 accounts, we'll be quickly revising those topics so that it will be helpful for us for preparations, revisions, right? We'll start with the first chapter. The first chapter that we discussed was profit or loss pre and post incorporation, correct? So
Yes,
in
sir.
that, the main principle for that particular chapter was no one can make profits without being in existence. That's the underlying principle. Now, in that chapter, we learned the accounting treatment. What was the accounting treatment? We divided the profits of the company or P&L of the company into 2, pre-incorporation, post-incorporation. Post-incorporation, whether it's profit or loss, what's the treatment?
P&L account.
Transfer it to profit and loss account. Whereas it's pre-incorporation, then pre-incorporation profit would be transferred to
Capital reserve.
capital reserve.
Reserve.
If it is a loss, then we have 3 options, right? Loss prior to incorporation account, amortize over the years, directly to P&L account in the first year itself, or consider as
Goodwill.
Consider as goodwill. Yes. Now, when we are identifying whether it belongs to a pre-incorporation profit or post-incorporation P&L, post-incorporation item, the basis of apportionment, first, if it is a pure pre-incorporation item or pure post-incorporation item, specific identification, we will bifurcate. If it is a common expenditure, common expenses, then we go with certain equitable basis. For that, what should we do? We should first go for any specific information given in the question. If specific information is given, then on that basis, it shall be apportioned. If specific information is not given, then check whether if it is related to sales. If it is related to sales,
Sales
ratio.
sales ratio. If not,
Time
ratio.
Ratio.
2 ratios that we have to calculate in any problem, any pre-incorporation, post-incorporation problem. First step that we do is calculate 2 ratios.
Sales ratio.
And
Time ratio.
time ratio. So based on this, we would bifurcate the profit and loss. Accordingly, we get the profit pre-incorporation, profit post-incorporation, and that accounting treatment that we had discussed earlier shall be applied. Clear?
Yes, sir.
Yes, sir.
That's it. These are the points. These are the concepts that we learned in the first chapter, profit or loss pre and post incorporation. Write down. Profit and loss pre and post incorporation. Pre and post incorporation. Below that, principle. No one can make profits without being in existence. No one can make profits without being in existence. Below that, accounting treatment. Accounting treatment. 2 arrow marks. 2 arrow marks. Pre-incorporation. Pre-incorporation and post-incorporation. Pre-incorporation and post-incorporation. Below post-incorporation, we'll write profit or loss into P&L account. Whereas under pre-incorporation, again 2 arrow marks. If it is a profit, capital reserves. If it is a loss, then 3 options. Loss prior to incorporation account, loss prior to incorporation account,
P&L account,
P&L account,
goodwill amortized to be.
goodwill account. Yes. Loss prior to incorporation account, P&L account, or goodwill account. After that, completely below that, apportionment. First point under that, pure pre-incorporation expenses. Second, pure post-incorporation expenses. And third, common expenses. Below common expenses, sub point 1. Below common expenses, sub point 1. Check for specific information given. Check for specific information given. Below that, second sub point. If no specific information, and if related to sales, then
Sales ratio.
apply sales ratio. Then apply sales ratio.
Else time
Third
ratio.
point. Third sub point. If not related to sales, apply time ratio. If not related to sales, apply time ratio. Everyone understood?
Yes, sir.
Yes, sir.
Okay. So that's it. These are the concepts that we have. We'll quickly look into some of the questions. If we can come to the material, page number 381, I think. Yeah, page number 381. We have question number 1. The business carried on by Kamal under the name K was taken over as a running business with effect from 1st of April 2013 by Sanjana Limited, which was incorporated on 1st of July 2013. The same set of books was continued since there was no change in the type of business, and the following particulars of profits for the year ended 31st of March 2014 were available. So they have given us sales, company period and prior period, selling expenses, preliminary expenses, written off, salaries, directors' fees, interest on capital up to 30th June 2013, depreciation, rent, purchases, carriage inwards, net profits. Purchase price, including carriage inwards for the post-incorporation period had increased by 10% as compared to pre-incorporation period. No stocks were carried either at the beginning or at the end. Required to draw up a statement showing the amount of pre and post-incorporation period profits stating the basis of allocation. Okay, write down. In any question, start with the following. Below that, identify the date of incorporation. Identify the date of incorporation. Below that, based on that, compute time ratio. Point number 3, compute sales ratio. So these are the 3 points that we have to take care in any problem. Before starting the main answer, these 3 information should be available with us. Right? So based on that, first identify the date of incorporation.
First
Date of-
July, sir.
1st July 2013.
1st July 2013. Yes. 1st July 2013. So give me the time ratio
1:3.
here. 1:3. It starts from April, ends in March, so 12 months. In that April, May, June, 3 months pre-incorporation, 9 months post-incorporation. So 3:9, 1:3 is the time ratio. Sales ratio.
1:4.
1:4.
Yes, pre-incorporation is 10,000, company post-incorporation is 40. In the pressure in the examination, we'll read like this and we'll write 4:1 as the sales ratio. It will happen. So we have to be careful. Pre-incorporation is to post-incorporation. So in the question itself, in the working note that we calculate sales ratio, always write the formula. Pre-incorporation sales is to post-incorporation sales. Then the possibility of going wrong will be very less. So sales ratio is 1:4. So once we are done with this, we can directly calculate prepare the statement. So here, selling expenses, which ratio?
Sales
Ratio.
Preliminary expenses,
Pure post-incorporation.
Post-incorporation.
correct. Salary,
Time ratio.
time ratio. Director's fees,
Pure
Or post-incorporation item.
incorporation. Interest on capital.
Based on the information given.
Correct. So based on the information,
Pre-incorporation.
incorporation, because it is up to 30th June. Incorporation date is 1st July. So it's pre-incorporation. Then depreciation,
Time ratio.
ratio, rent,
Time
Time ratio.
purchases.
Sales ratio.
Ratio.
Information given, sir.
Very
Specific
good.
information.
Specific information given. What is the information? Purchase price including carriage inwards for post-incorporation period had increased by 10% as compared to pre-incorporation period. No stocks were carried either at the beginning or end of the period. So no openings, no closing stock. Whatever is purchased is sold entirely. So using this, can we find out the purchase ratio? The ratio for you that we have to use. Okay. So what have they given us? We're getting various varied answers. So they have told us purchases for post-incorporation is more, correct? More by 10%. So if I consider pre-incorporation purchase per month is X, what would be the post-incorporation purchase per month?
110.
10x.
X plus 10.
1.1x.
Yes. sir.
Yes, sir.
10% increase. Correct? So 1.1x. Pre-incorporation period was 3 months. So
3
total
months.
purchases is 3x.
3x.
Post-incorporation period 9 months. Total
9.
purchase
9.
9.9x. So 3x is to 9.9x or 3 is to 9.9. Or further simplify, 1 is to
3.3.
3.3.
1 is to 3.3 will be the ratio.
So shouldn't we take it on the basis of sales?
Why?
Because purchases depends on sales.
Purchase price, okay, for the post-incorporation period had increased by 10% as compared to pre-incorporation period. So you're telling that it's not the quantity that has increased, only the price.
Yes, sir.
Okay, going with that, yes, you can go with 4:1 ratio, or that's 1:4 ratio. Here it increased by 10%. So that can be considered, but I think this is logical. 1:3, 3.3.
Okay.
Anyhow, we'll look into the answer later, or now itself we can see. Yes, that is how the institute also would have considered 1:3.3. Yes, the use of the word price is misleading, I understand, but when they are saying purchase increased by 10%, they are going with the amount of purchase itself, the value itself.
Okay, sir.
Yes. So 1:3.3 will be the purchase ratio. Same ratio can I apply for carriage inward?
Yes, sir, because
Yes,
they have
sir.
said
Yes,
that
sir.
including carriage inwards.
Including carriage inward. So with this,
But I have one query, sir. They have told that while finding the purchase, they said that in the bracket it was including carriage inwards. So x plus 1.1x is equal to, we should take 25,000 or 25,000 plus
no.
101.
So see, what are we interpreting here? By the insertion of the word including carriage inward, what are they telling is not only purchase price increased, it also, that increase was also impacted in carriage inwards as well. That means carriage inwards also increased by 10%. So both increased by 10%. So that is to mean the basis of apportionment can be the same for both. Even if the case, if you consider the total increases of X as 25,000 plus 1019, ultimately the final answer should be the same. Instead of applying the ratio individually, you can apply it combined. Ultimately, the basis of apportionment, the amount that we get for pre and post will be the same.
Yes, sir. Sir, in
Yeah.
case if they are not giving any purchase price information, should we go with the sales information? If there is a lack of information about purchase.
Obviously, because purchase is related to sales.
Yes, sir.
Right?
Thank you, sir.
Yes. So purchase, carriage inwards, all cases will go with sales ratio if nothing is given. Yes, Harshita.
Sir, by any chance, do you know which year this is, sir? Because I have the old material printed and I don't know if it's
In old material also it should be there. I think it was
Okay,
in
sir.
page number 201.
Okay, sir. I'll search for it in the. Thank you, sir. Thank you, sir.
Okay, fine. Next question. Question number 2. Roshani and Reshma were working in partnership, registered a joint stock company under the name of Happy Limited on May 31st, 2016 to take over their existing business. Summarize P&L account as given by Happy Limited for the year ended 31st March 2017 as under. They have given us the P&L account. Prepare a statement showing allocation of expenses and calculation of pre-incorporation and post-incorporation profits after considering the following information. GP ratio was constant throughout the year. Depreciation includes 1250 for assets acquired in post-incorporation period. Bad debts recovered amounting to 14,000 for a sale made in 2013-14 had been deducted from bad debts mentioned above. Total sales were 18 lakh rupees, of which 6 lakh were for April to September. Happy Limited had to occupy additional space from 1st of October 2016, for which rent was 2,400 per month. These adjustments we have already discussed in the class. Right? First, we'll go with the same approach. What is the date of incorporation?
May 31st, 2016.
31st, 2016.
Yes, May 31st, 2016. So in that case, what will be our time ratio?
1:5.
1:5.
Yeah, April, May, 2 months, correct? Pre-incorporation, and from June, it is 10 months post-incorporation. 1:5 is the time ratio. Sales ratio?
1:2.
1:2?
Yes, sir.
No.
Sir, the post-incorporation period is 12 months, sir.
No. See, they registered a joint stock company on May 31st. That means April and May it's pre-incorporation. From June till March it is post-incorporation. 2:10, 1:5.
Yes, sir. Yes, sir. I read May as March. Yes, thank you, sir.
Yes, those things happen. Sales ratio, anyone? I got one answer in the chat.
1:7.
1:7.
7.
1:7. We'll see. I don't think so. 1:7 is right. See, they have given us 18 lakh as the total sales. Correct. Out of which 6 lakh were for April to September. But pre-incorporation period is April and May. How do I get, Ritvik? How do I get the sales for 2 months?
Divided by 6 into 2.
Yes, presuming the sales to be uniform, correct? So 6 lakh for 6 months, for 2 months it is 2 lakhs. So pre-incorporation sales is 2 lakhs. What would be the sales of post-incorporation? 16 lakhs.
16 lakhs.
16 lakhs.
1:8.
1:8.
1:8. Understood?
Yes, sir.
Yes.
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 Yes. It was April to September. So the moment we get 6 lakh, we feel that it is entirely related to pre-incorporation. No. We have to read the question carefully. 1:8 is the right answer. So everyone understood 1:5, 1:8 time ratio, sales ratio? Yes.
Yes,
sir.
Sir, we should give presumption, sir.
What was that?
We should give presumption, sir.
On what? On uniformity?
Yes, sir.
Yes. Preferably, even if you don't give, there will not be losing. You will not be losing any mark there. But preferably, always good to give note wherever we are presuming. Yes.
If we give, we'll get marks, sir.
I'll not assure you that you'll get marks, but definitely it add value to this answer, which will help you to get marks in other average problems, other average solutions. Okay, that is always good practice. So initially, if you have presented your answers in a very good manner, yes, you might not get extra marks for that problem, but that creates a good impression, which definitely helps you to gain marks in the other questions later, where we have presented averagely. Yes. Okay, fine. Now, gross profit. How do you apportion gross profit? Or rather, the basis of apportionment. Salary?
Time
Time
ratio.
Ratio. Interest on ventures?
Post-incorporation.
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 Sales commission?
Sales ratio. Information given in the bad debts.
Yes. So, what have they given us? Bad debts recovered has been adjusted in the bad debts. What should we do?
Add it
Add
back,
back.
sir.
Add back. So 49,000 plus 14,000, you get 63,000 as bad debt expenditure. What happens to this bad debt recovery?
Pre-incorporation.
Yes,
Pre-incorporation.
it will be considered as indirect income. It will be shown as income in the statement that we prepare. So in the income, we will bring the bad debts recovery, and it is completely pre-incorporation. Why? Because bad debts was written off earlier.
Yes.
So it's pre-incorporation item. Coming to this 63,000.
Divided in sales
Divided by
ratio.
sales ratio.
Sales ratio. Yes, it will be in sales ratio. Depreciation.
Time ratio.
Information given.
Information given.
Information given. Out of 19,250, what are they telling? 1,250 is related to?
Post-incorporation.
1,250 is post-incorporation. Balance 18,000? Pre-incorporation.
Time.
Time ratio. They're not telling that 18,000 worth of depreciation related fixed assets are sold. No. They are telling that these fixed assets were purchased after incorporation. So it has to be post-incorporation. That means other assets were existent at the time of a pre-incorporation period only. So it has to be uniform over time. So it will be time ratio. Normally, depreciation time ratio with some adjustment in this question. Clear?
Yes, sir.
Rent.
Yes, sir.
Specific information.
Specific
Information
information
given.
38,400, we'll divide it into two. One is normal rent, second one is additional rent. That additional rent that we have paid 1st of October 2016, for which rent was 2,400 per month. So how many months we have paid rent?
6 months.
2,400 into 6?
14,400.
14,400 pre or post?
Post income.
1st of October 16. It's falling in the post incorporation period. The balance 24,000.
24,000.
Yeah.
Time.
1:5.
Uniform. It's uniform during the period. All 12 months we had occupied. So 2 months pre-incorporation, balance post-incorporation. Then audit fees. If nothing is given,
You can also think it as a tax audit, sir.
we can always give a note, but normally when nothing is given, consider it as statutory audit.
Statutory
However,
audit.
give a note on that also. That's all. These are the allocation items that we have. Correct. So in this, yes, these questions will be easy. First, we should be very careful in calculation of ratios, those two ratios, sales ratio and time ratio specifically, we find that many of us are going wrong there, right? So we have to focus on that calculation of ratios. After that, when we are presenting, yes, after calculating the ratios, presentation is easy, apportionment is easy. Focus on specific information given, understand the specific information. Sometimes it need not be applicable to that particular item. It might be part of certain items only, like depreciation, what we understood, right? The other part need not be pre-incorporation. The other part should be time ratio. So those aspects, be careful, and please do not forget to give notes, because here this is less a technical chapter, more focus on presentation in the exam. Okay, so more focus will definitely be on presentation. So focus on that presentation. So these were the two questions that we had to discuss. Since our exams RTP is not yet released, I'll go with May 23 RTP. We'll look into one of the questions there. Profit or loss prior to incorporation. This is the question that was there in the May 23 RTP. Messrs. New Venture, who was carrying on business from 1st of June 2021, gets itself incorporated as a company on 1st of October 2021. The first accounts are drawn up to 31st March 2022. Gross profit for the period is rupees 1,20,000. Following information is given. General expenses are 24,000. Director's fees is 24,000 per annum. Incorporation expenses 4,000. Rent up to 31st December 2021 was rupees 6,000 per annum, after which it was increased to rupees 8,000 per annum. Salary of the manager, who upon incorporation of the company was made a director, is rupees 12,000 per annum. His remuneration as director is included in the above figure of fees to the directors. Advertisement expenses of 5,000 pertains to the incorporated company. Bad debts 4,000 rupees. Give statement showing pre-incorporation and post-incorporation profits. Net sales are 20 lakh rupees. Monthly average of which for the first 4 months is one half of that of the remaining period. Company earned a uniform profit. Interest and tax may be ignored. Beautiful problem. Definitely we'll go wrong here. I am confident of it. Calculate the time ratio. Again, we are getting varied answers. 1:1, 1:2, 2:3, 5:6. Different combinations. Even 4 options MCQs are not sufficient. Okay. Tell me the date of incorporation.
1st October 2021.
2021. Pre-incorporation period, how many months?
4 months.
4 months.
4 months.
Very good. Business commenced on 1st of June. Correct. So June, July, August, September. 4 months. I didn't speak anything during that time. So 4 months. June, July, August, September. So pre-incorporation period 4 months. Post-incorporation
6 months.
6 months.
6 months. From October till March, right? 6 months. So it has to be 4:6.
2:3.
2:3.
Yes, 2:3 time ratio. Everyone.
Yes, sir.
Yes, sir.
Yes, sir.
I'll come down to the last part of the question to calculate sales ratio. I've got 2 answers. Both are correct. In the sense, 2 responses. So they are telling monthly average for the first 4 months is 1/2 of that of the remaining period. That means pre-incorporation sales are lesser or more?
Lesser.
More.
More? First 4 months is pre-incorporation or post-incorporation?
Pre-incorporation.
So average sales of first 4 months is 1/2. 1/2 means what? Not 1.5.
Half.
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 1/2 means 1/2.
1/2.
Yes. So half of that of the remaining period. And they are talking not of the total sales, they are talking of monthly sales. Monthly average sales. So if monthly average sales pre-incorporation is X, post-incorporation will be double, 2X. Correct. Instead of taking post-incorporation as X and half of X, it will be difficult for calculation. We will double. So if post-incorporation it is 2X, pre-incorporation it will be half of it, X. In that case, total sales pre-incorporation is 4X, 4 months. 4 months, right?
Yes, sir.
Yes.
Yes, sir.
Yes. Total sales post-incorporation will be 2X into 6
months.
12
months.
X. 4X is to 12, 1 is to 3.
1:3.
1 is to 3 is the sales ratio. Understood?
Yes.
Yes,
Yes,
sir.
sir.
Yes,
Yes,
sir.
sir.
Have the time ratio and sales ratio here. We will look into the problem. They have given us the gross profit 1,20,000, which is the ratio that we'll apply. No
1 is
specific
sales ratio.
Yes, sir.
Sales ratio.
ratio. Yes. General expenses,
Time ratio.
Time
ratio.
time
Time
ratio.
ratio.
No other basis. Directors fees,
Pure
Post-
post-incorporation.
Corporation, half of.
very good. 6 months post incorporation. This is 24,000 per annum. So 12,000 for 6 months. Incorporation expenses,
Post incorporation.
incorporation amount
4,000.
4,000.
Yes, sir.
Yes, there
Yes,
is no plan here. Yes. Then rent up to 31st December was 6,000 per annum, after which it was increased to 8,000 per annum. Give me the amounts of pre-incorporation and post-incorporation. We have to solve. Some of us are sitting as if it is a movie, watching a movie.
Sir, can you show the date of incorporation?
1st of October, 1st of June.
Okay, sir.
Vasudha Vital. Vasudha, I thought, check the question again. Kartikeya again, Kirtana Reddy, Darshan, Vindhya, Akshay, Varshini. We are not reading the question right. We are not reading the question correctly. This is not 6,000 per month. This is 6,000 per annum. Priyanka. These are the kind of mistakes that we do, and the sad part is we don't realize there, and after the exam, after the results come out, we blame the institute that I have written correctly. They have not given me the answer. Okay, fine. What is the answers that we are getting? Pre-incorporation, are we getting 2,000?
Yes, sir.
Yes, sir.
Okay. So it was 6,000 per annum means what is per month?
500.
500 per month.
500.
So June, July, August, September, 4 months, 500. That means 2,000 rupees.
2,000 rupees.
Correct. So balance should be post incorporation. In post incorporation, August, September, October, right? October, November, December.
October, November, December.
3 months, 1,500.
1,500.
Plus next 3 months, it was 8,000 per annum. That means per month is
66.66.
67 into 3, 2,000.
2,000.
2,000.
1,500 plus 2,000, 3,000.
3,500.
Yeah, so it's 2,000 and 3,500. Next, salary of the manager who upon incorporation of the company was made a director is rupees 12,000 per annum. His remuneration as director is included in the above figure of fees to the director. Beautiful adjustment. No one with the answer?
Sir, is it 4,000 and 20,000?
4,000 and 20,000? 4,000 and 20,000? For 1 year, it's 12,000.
No, sir, the given director fees is 24,000, right? So out of that, 4,000 for pre-incorporation and 20,000 for post-incorporation.
This is already done. Director's fees we have already discussed. Director's fees should be post-incorporation. There cannot be a director pre-incorporation. Now, what are they telling here? Salary of the manager who upon incorporation of the company was made a director is 12,000 per annum. So manager's salary was 12,000 per annum. So before incorporation, 4 months, he was paid 12,000 per annum basis salary. That means what was the salary that he would have paid? 1,000 per month, 4,000 rupees.
Yes, sir.
Yes.
Correct. So
Yes, sir.
pre-incorporation, he was paid 4,000 rupees. Post-incorporation, he was made a director. His remuneration was already included in director's fees. So as a manager, he will not be paid anything nil. Understood?
Yes, sir.
Yes, sir.
Yes, sir.
Sir, in
So
case
that is
director,
that's why they have specifically given his remuneration as director is included in the above figure of fees to director. That we have already considered, right? That we have already considered earlier. Director's fees is already considered as post-incorporation. So salary to manager will be pre-incorporation. Yes, Vindhya.
in that case, this director fees 24,000, we have to deduct 4,000 and then.
No, we are not
20,000.
deducting. See, simple. He is acting in two capacities. Before incorporation, he was a manager. He was paid as a manager. Before incorporation, June, July, August, September, 4 months, he was paid as a manager. 12,000 per annum was his package. So 1,000 per month, 4,000 he was paid. Upon incorporation, he was appointed as director. So now he is paid as a director. As a director, he is being paid 2,000 rupees per month. So from October, for 6 months, 2,000 into 6, 12,000 will be paid. So whenever we are considering director's fees as an item of expenditure in our statement, we have only post-incorporation column, 12,000. Whenever we are considering salary, manager's salary as an item in the statement of apportionment, then we will only have pre-incorporation column, 4,000 rupees, post-incorporation column, 0.
In that case, I didn't understand the second sentence. Could you please explain that his
Yes,
remuneration
see,
as
simple.
director is included?
What are they telling? Salary of the manager who upon incorporation of the company was made a director. This we will ignore as of now, is rupees 12,000 per annum. So salary of a manager is rupees 12,000 per annum. That means pre-incorporation is paid 4,000. Simple. Now, this person upon incorporation was made a director. His remuneration as director, that is after incorporation, is included in the above figure of fees paid to the director. That means he is not being paid as a manager now. He is only paid as a director, which is already included in director's fees, point number B. Okay, so no manager salary post incorporation, simple.
So that second sentence is kind of just to confuse you, right? I mean, no action needs
no,
to be
technically
taken.
it has been brought in to give clarity, to ensure that we don't go wrong, but it has to be understood correctly. That's all.
Okay, sir.
Next one, advertisement expense of 5,000 pertains to the incorporated company.
Post-incorporation.
Post-incorporation.
Sales.
Sales ratio.
That's all. That's all, I think. Yes, that's it. So these were the items, right? So good question that was asked in May 23 RTP. Chances that it can be asked in your exams. So with that, we are done with the first chapter. Any doubts in this?
Sir, I'm so sorry. Could you tell the sales ratio for this one, sir? Because I solved it, then I got logged out of the meeting.
Okay, what was the sales ratio that we got?
2:3.
2:3.
3.
2:3.
No, 1:3.
1:3, sir.
1:3.
4:6, 1:3.
Time is close. Sales ratio is 1:2.
Thank you, sir. Thank you.
Yes, it was 4x is to 12x, 1:3. Correct.
Thank you, sir.
Okay. Any doubts in this?
No, sir.
No. So with this, we will move on to the next chapter. The second chapter, simple chapter that we discussed was bonus issue and right issue, wherein we divided into two categories. First bonus issue, next rights issue, right? Bonus issue, it's also called as capitalization of profits. Why it's also called as capitalization of profits? Because we are capitalizing the profits, that is transferring reserves to capital. That is what we are doing. So it's governed by section 63 of the Companies Act 2013. What does section 63 talk about? It says you can issue bonus shares out of three things: free reserves, securities premium, redemption reserve. With regard to securities premium, there is one restriction. It has to be received in
Cash.
whom?
For listed company.
Only for listed companies, right? For listed companies, it has to be received in cash. So this is the basic that we have to find out. If questions are being asked, they will ask us. It can be a separate question specifically related to bonus issue, or it can be part of other questions like redemption of preference shares, or it could be investment accounting, right? So any of those chapters or any of those questions, it can be clubbed. Now, the points that we have to look into is, first we have to calculate number of bonus shares to be issued. That based on the information given. For every 5 shares, 1 share; for every 6 shares, 2 shares. So based on the information given, we have to calculate the number of bonus shares, and then we have to identify the reserves that we are utilizing. Given an option, which is the first reserve that we will be considering? Strict that bucket. Next,
Securities premium.
mostly our bucket, free reserves. Correct? Yes. Once we identify these reserves to be utilized, then we have to pass journal entries. Only 2 journal entries. First, due entry. Reserves will be debited. Concerned reserves account debited to
Shareholders.
to shareholders account. The terminology becomes important. We should not deviate from it. Then allotment. Bonus to shareholders account debited to
Equity share.
Equity share.
capital account.
Equity share
Simple.
capital.
Correct? Simple discussion. Write down. Accounting for bonus issue. Accounting for bonus issue. Below that, capitalization of profits. Within brackets, we can write capitalization of profits. Within brackets again, section 63 of the Companies Act. Section 63 of the Companies Act 2013. Below that, bonus issue can be out of. Bonus issue can be out of 3 remarks. First, capital redemption reserve. We'll write in that order itself. Capital redemption reserve. Second,
Securities premium.
and third,
Free reserve.
securities premium, and third one, free reserves. Below that, below securities premium, within brackets, for listed companies, only if it is received in cash. Only if it is received in cash. Only if received in cash. Below that, while solving the problems, following steps to be followed, following steps to be considered. First one, compute the number of bonus shares to be issued. compute the number of bonus shares to be issued. Point number 2, identify the reserves to be utilized. Identify the reserves to be utilized. Point number 3, pass journal entries. Pass journal entries. Below pass journal entries, journal entry number 1, concerned reserve account debit. Concerned reserve account debit to bonus to shareholders.
Bonus to
Shareholders account.
Yeah, bonus to shareholders account. JE2, journal entry number 2. Bonus to shareholders account debit
Equity share.
to equity share capital account. Bonus to shareholders account debit to equity share capital account. That's all, right? This is what is there in bonus issue. The next part of it, before looking into some of the questions in bonus shares, we'll first learn the concepts of rights issue. Now, in case of rights issue, it's the concept is coming from section 62(1)(a) of the Companies Act, which says whenever company is issuing fresh shares, it has to be first offered to existing shareholders. Correct. So whenever shares are offered to existing shareholders, obviously there are exceptions, various exceptions that we have looked into: ESOP, conversion of debt into equity, etc., private placements. So whenever shares are offered to existing shareholders, that is called rights issue. Now, why it's called rights issue? Because shareholders have the right. Now, once the rights issue are offered, shareholders have 3 options. They can accept it. Once they accept it, they have to subscribe, they have to pay the money, get the shares. Second, they can reject it outright.
Reject the offer.
Yes, reject the offer. Once they reject it, company has the discretion to dispose it of as it requires. It can offer it to any other person. The last one, it can
Renunciation.
Renounce.
shareholders can renounce it to any other person, renounce the right. Right. So in this case, the calculation of X right price becomes important. X right price and cum right price that we are talking about, right? Value of a right, right? To calculate value of a right. Now, why this value of a right or X right price and cum right price would be computed? Because right issue happens at a value lesser than the market price, because of which the market price after right issue will be lesser than the market price before right issue. So X right price is before rights issue or after rights issue?
After.
After. Gone. X has become X right price. So it is after right issue. Cum right price means right issue is still coming. So cum right price is before rights issue. So how do we calculate value of a right? It is cum right minus X right or X right minus cum right?
Right.
Cum right minus
X.
Cum right will always be higher than X right. So cum right price minus X right price. How do we calculate X right price? We know the market capitalization before rights issue. How do we get that? Cum right price into number of shares before rights issue. So that is market capitalization before rights issue plus whatever we have received from rights issue. How do we get that? Right issue price into number of right shares issued. That's the total market capitalization after rights issue divided by total number of shares after rights issue. How do you get total number of shares after rights issue? Existing shares plus new shares issued. This gives us X right price. Once we have X right price, we can calculate value of a right. Cum right minus X right. Now, once we get the value of a right, how do we compute the amount that has to be charged as a premium for renouncing of a right?
Value of a right into existing shares.
Value of a right into existing shares. In the sense, if one share is offered for every 4 shares, value of a right into 4. That gives us the premium to be charged so that the existing shareholder will not incur a loss. Correct? These are the discussions that we had in the rights issue concept. Any doubts in this?
No, sir.
No, sir.
No? Everyone understood the cum right, rather the calculation of X right price?
Yes, sir.
Yes, sir.
Yes, sir.
Write down rights issue rights issue. Below that, section 62 1A. Section 62 1A. Shareholder has three options: accept, reject, renounce. Shareholder has three options: accept, reject, renounce. Below that, value of a right is equal to come right price minus X right price. Come right price minus X right price. So under or highlight come right price and write before rights issue, besides X right price, right after rights issue. Okay, value of a right equals come right price minus X right price. Highlighting come right price, we'll call it before rights issue, price before rights issue, market price. X right price is market price after rights issue. Next, below that, X right price is equal to X right price is equal to market capitalization before rights issue. Market capitalization is before rights issue plus cash flows generated from rights issue whole divided by number of shares after rights issue. Number of shares after rights issue. So this market capitalization before rights issue is come right price into number of shares existing. Cash flows generated from rights issue is number of shares issued into issue price. Number of shares issued into issue price. Done?
Yes, sir.
Yes. That's it. So these were the discussions that we had. But maybe one more point, write down. A
Yes.
premium to be charged for renunciation. Premium to be charged for renunciation is equal to premium to be charged for renunciation is equal to value of a right into existing number of shares. Value of a right into existing number of shares.
Yes, sir.
Yes. Come to the material. We'll look into some of the questions here. In the material that was shared now, it would be page number 331. You will have question number 1. Following is the extract of balance sheet of Solid Limited as on 31st of March 2008. They have given particulars: authorized capital, preference shares and equity shares, issued and subscribed capital, preference shares and equity shares, reserves and surplus, general reserve, capital reserve, securities premium account, P&L account, secured loan, debentures. On 1st of April 2008, the company has made final call at ₹2 each on 9,000 equity shares. The call money paid and received by 20th April. Company decided to capitalize its reserves by way of bonus issue at the rate of 1:4. Share premium of 25,000 includes a premium of 5,000 for shares issued to vendors pursuant to a scheme of amalgamation. Capital reserves include 40,000 being profit on sale of machinery. 20% of 12% debentures are convertible into equity shares of ₹10 each, fully paid on 1st of July 2008. Show necessary entries in the books of the company and prepare the extract of the balance sheet immediately after bonus issue, but before conversion of debentures are convertible. Okay, full stop. Next is, are convertible debenture holders entitled for bonus shares? Okay, first one. First, we have to pass journal entries for this final call. What would be the due entry?
Final call
Equity
account,
share, final
equity
call
share
account,
capital
equity
account.
share.
Share capital.
Yes,
Share
equity share final call account debited to equity
Share
share
capital.
capital account.
Capital account.
It was ₹8 paid. So correct. 90,000 into ₹2. Then receipt. It was received by 20th of April. So bank account debit to equity share final call
Equity
account.
share
Simple.
final account.
Then they are deciding to capitalize its reserves by way of bonus issue at the rate of 1:4. What would be the number of bonus shares?
Four bonus for one wish.
22,500 shares.
22,500.
22,500.
There were 90,000 equity shares. So into 1/4.
22,500.
22,500.
Yes. 22,500 shares. Now, can we directly pass journal entries for bonus issue?
We should make fully paid up.
The debentures convertible debentures should also be considered.
Correct. So with regard to that, what is the provision that we have learned for convertible debentures? For convertible debentures,
Allotted, but when the registration or that
conversion,
entry into
when the conversion
numbers,
happens. So basically, bonus shares should be provided for. Right? Bonus shares should be provided for those convertible debentures. So as on the date of allotment of bonus shares, we will be allotting only 22,500 shares. That is point number 1. Now, can I directly pass the journal entries?
No, sir.
Why no?
Sir, because debentures have to be converted into equity shares.
No,
So we have to
debentures
pass
conversion
this.
is happening on 1st of July 2008. We are still in April.
Is that reserves to be utilized?
Reserves to be utilized, yes. We will check on the reserves to be utilized. Before that,
We have to adjust the profit.
authorized share capital.
very good, Ritvik. See, authorized capital is 1 lakh equity shares of ₹10 each. We have already issued 90,000 shares. If we further issue 22,500 shares, it exceeds the authorized capital. So first we have to increase the authorized capital. What is the journal entry to increase the authorized capital?
There is no entry.
No entry.
Journal
for
entry, we have to just give a note.
giving.
Correct? We have to just give a note for increase of authorized capital. When we are increasing the authorized capital, we have to also consider the convertible debentures that we will convert later. Now, what is the provision? See, apart from that, yes, this is 22,500 shares that we are issuing. 22,500 into 10, 2,25,000. What are the reserves that we will be utilizing? First,
Securities premium.
Here,
can I use capital reserve?
No.
no, sir.
No, it has to be CRR, right? Capital redemption reserve. So no, we are not using capital reserve. So we can use securities premium of 25,000, but they have given that 5,000 is received is other than cash. It is issued to vendors as per based on amalgamation. So can I use that 5,000?
By giving an assumption.
Yeah, no, that it is a
listed company.
Listed
Yeah, it's
company.
not a listed company. Giving an assumption that Solid Limited is presumed to be an unlisted company.
Unlisted company.
In that case, we can use. Same way, if we are presuming it to be a listed company, we will not use. Right? That's the presumption that we'll give. 25,000 that we can use. Then we anyhow have general reserve and profit and loss account, which we can use. So based on that, we'll pass the journal entries. After that, they're asking one more question. Are debenture holders entitled for bonus issue, bonus shares? We have discussed that, yes, sir. We have to provide for it, but it will be allotted only upon conversion. Now tell me, what is the number of shares that we have to provide for bonus shares?
Thousand 250 shares.
1000 equity shares?
1250 equity shares.
1250 shares. So what is the number of debentures that we have? 5000. Correct?
Yes, sir.
Out of 5000, only 20% are convertible. 20% of 12% debentures are convertible into equity shares. That means only 5000 into 20% is
1000.
1000.
1,000.
in that 1/4, which is
250.
50.
250.
understood.
Yes,
Yes,
sir.
Yes, sir.
Yes.
wrong. Wrong.
Provided for.
No. When we are talking about debentures, 5000 shares, 5000 debentures, 1000 debentures, they are of 100 rupees. The shares are 10 rupees. So it has to be into 10. When we are converting, we have to convert in equitable terms. Equitable value, correct? So 5 lakh worth of debenture holders, 20% is converted to equity share. It's 1 lakh worth of equity shares divided by 10. It is 10,000 equity shares that we are converting into. When we are converting it into 10,000 equity shares divided by 4, 2,500 shares is what we have to provide for. While converting, we'll convert it into 10,000 plus 2,500, 12,500 shares. Everyone understood?
Yes, sir.
Yes, sir.
Yes, clear with this?
So why are we dividing by 4?
Because 1:4. Bonus issue.
Yes, sir. Yes, sir.
Sir,
Everyone
won't it,
understood?
won't it take the face value as 10 and the balance 90 as securities?
Only if
But-
it is given specifically. Right? If nothing is given, in this case, see, if it's a redemption of debentures or conversion of debenture related question, then definitely they will specify. In these kind of questions, they will definitely not go in such detail. We will have to convert
Okay.
into equitable terms at par. Yes, Pradeep.
Sir, could you
Sorry,
please explain
Nitya.
that?
Yeah.
Hear me,
Yes,
sir?
yes, tell me.
So that could you please explain that 5,000 rupees vendor point here?
Yes, 5,000 rupees vendor point. That 5,000 rupees securities premium was received how? By allotment of shares to vendors in pursuance of a scheme of amalgamation. So it was amalgamation of a company. Based on that, shares were allotted at a premium. So that securities premium is not received in cash. It was received by virtue of purchase of business. It was not received in cash. So can we use that securities premium? Depends upon whether it's a listed company or not.
Yes.
Question is silent. Therefore, we have to presume.
Assume that it is listed, right?
Or otherwise, both are fine.
Okay, sir.
And when we are preparing the balance sheet here, we should not consider that 2,500 bonus shares that we are providing for, because they are specifically given balance sheet has to be prepared before conversion of debentures. Okay, so that discussion that I gave with regard to 2,500 bonus shares are being provided for debenture holders is only for the last part of the question. Are convertible debenture holders entitled for bonus shares? So for that, this is what the answer should be. Yes, they are entitled. Accordingly, compute the number of shares that we have to provide for. Understood?
Can we give a small disclosure that there are convertible debentures which need to be allotted after?
In financials, there is no requirement. As per Schedule 3, there is no requirement. Okay, but in the resolution which is passed, okay, when in the resolution which is passed in the general meeting for approval of bonus issue, there definitely we have to give.
Okay.
Yes.
Excuse me, sir.
Yeah.
Sir, if I'm not wrong, there is some limit for listed companies and all those things, according to SEBI. If they come, sir, turnover limit and all those things for listed companies.
To be a listed company or
to be a listed company.
Obviously, yes. There is limit, not turnover as such. They have limit with regard to net worth and profitability. There are various restrictions. I think you will learn it in your intermediate syllabus itself. ICDR regulations.
I don't think so. No.
You don't have ICDR regulations
No.
later?
No,
Oh,
sir.
maybe they have removed it. Okay. It was in final. Now it's not in final. I thought they have brought it in inter. Okay. It's not there. No issues. So it's there. The limits they have given. To become a listed company, there are certain conditions to be satisfied. Yes. But going with the question, should we interpret based on that? No, definitely don't go into that detail. Not required.
Yes.
Come to question number 2 in page 328. A company offers new shares of rupees 100 each at 25% premium to existing shareholders on 144 basis. The cum rate market price of a share is 150 rupees. Calculate the value of a right. What should be the X rate market price? Similar problem we have solved in the class. Easy. What is the issue price?
125.
Ratio for every 1 share, for every 4 shares, 1 share. Using that, compute the X rate price.
145.
150 is the cum rate market price into 4 plus 125 into 1 divided by 4 plus 1, 5. So 600 plus 125, 725 divided by 5. That is what we get?
145.
145.
145. And if that is 145, what is the value of a right?
5.
5 rupees.
So what would be the premium that they have to charge?
20.
20. 4 into 5 rupees value of a right. That's it. Simple. So these were the 2 questions that I wanted to discuss in this chapter. We will come to the RTP. Question number 5 in the RTP. Following items appear in the trial balance of Satish Limited as on 31st of March 2022. 9,000 equity shares of rupees 100 each. Capital reserve including 80,000 rupees being profit on sale of plant. Securities premium. Capital redemption reserve. General reserve. P&L account. Credit balance. The company decided to issue bonus shares to equity shareholders at the rate of 1 share for every 3 shares held. Company decided that there should be minimum reduction in free reserves. Pass necessary journal entries in the books of Satish Limited. Simple. First, calculate the number of shares. Number of bonus shares.
$3,000 shares.
3,000. 9,000 into 1 by 3. Correct?
3,000.
3,000 shares. 3,000 into 100, 3 lakh. 3 lakh is the amount required. What are the reserves that we can use here?
CRR.
CRR.
3,000.
Securities premium.
0.4.
General.
Securities premium 80,000. Still we want 1.6 lakh.
General reserve.
General reserve.
Yes.
General.
That's all. Simple.
Yes,
Next
sir.
one. Issue of right shares. A company having 1 lakh shares of rupees 10 each as its issued share capital and having a market value of rupees 46 issues right shares in the ratio of 1:10 at an issue price of rupees 31. Pass journal entry for rights issue. What's the journal entry that we have to pass?
Regular issues.
Regular issue of shares. So what's the number of shares that we are issuing?
10,000 shares.
10,000.
Correct. So 10,000 shares. So regular issue, if we are going with regular issue, what is the securities premium amount per share?
21.
21.
21, because issue price is 31, face value 10 rupees, 21 rupees securities premium. Balance 10 rupees goes to equity share capital, 21 rupees goes to.
Securities.
Yeah, that's all.
7.
With that, we are done with the second chapter also. Any doubts in this?
No, sir.
Clear?
Yes, sir.
Yes. Okay, fine. We'll move on to the third chapter. After this, we discussed about redemption of preference shares. Correct? Redemption of preference shares. Now, in case of redemption of preference shares, the concept, see, redemption of preference shares as such is simple. We are repaying it to preference shareholders. But why we have to discuss in detail is because of section 55. What does it say? It says, since you are reducing your share capital before paying your external liabilities, you have to compensate for it. How do you compensate for it? There are 2 ways. Either issue fresh shares. It can be equity or preference, so that you're refilling that share capital. Or you have to create a reserve. What is that reserve?
Yeah.
Create capital redemption reserve out of
General reserve.
Free reserves.
Free reserve.
Yes, out of free reserves. Can I use securities premium to create CRR?
No, sir.
Not possible. Yes, it should only be from free reserves, or it could be combination of fresh issue as well as CRR to be created. Now, given an option, will the companies issue shares or use or create CRR?
Issue shares.
Will they issue shares? No. Given an option, they create CRR. Why? Issue of shares results in dilution of.
Dilution of.
So, given an option, shareholders also will go with CRR itself, CRR creation itself. However, in some cases, the company is bound to issue shares. For that, we can convert, or we can divide the entire discussion into 4 different parts. 1, insufficient free reserves, insufficient bank balance, or rather sufficient free reserves and sufficient bank balance. If you have sufficient free reserves to create CRR, sufficient bank balance to pay the shareholders, we are looking from both liabilities point of view as well as assets point of view. So if we have sufficient free reserves and sufficient bank balance, what is the number of shares to be issued?
Nil.
0, correct. If we have insufficient free reserves, but we have sufficient bank balance, from liability point of view, we have to issue shares. To calculate the number of shares, what do we consider?
Face value.
Face value.
Nominal value. So how do we calculate the number of shares? Nominal value of preference shares being redeemed less free reserves available to create CRR. We get the shortage divided by
Face
value of the shares being issued. We get the number of shares to be issued. Correct?
Yes.
Third scenario. We have sufficient free reserves, but insufficient bank balance. Here we go with
Issue
price. Very good. So amount required for redemption, including premium. Here we are not going with nominal value. Amount required for redemption less bank balance available for payment, available for redemption, gives us the shortage. This is the amount to be raised divided by
Issue
price will give us the number of shares to be issued. Fourth scenario, insufficient free reserves, insufficient bank balance. As per 2 or 3, whichever is
higher.
Everyone clear with this?
Yes,
Yes, sir.
One special point, utilization of securities premium, section 52 says securities premium can be utilized towards premium payable on redemption of preference shares. However, this is not applicable for companies which are prescribed in section 133 of the Companies Act, that is accounting standard related. What the institute presumes, all companies under discussion fall under that category. Therefore, securities premium or premium payable on redemption of preference shares, we cannot use securities premium to write off such premium. We have to go with
It is.
free reserves. This is what we have learned, right? That's all. These are the points that we had learned in redemption of preference shares. Any doubts in this? No? Good to go? Okay, write down. Redemption of preference shares. Redemption of preference shares. Below that, preference shares can be redeemed. Preference shares can be redeemed two arrow marks. Two arrow marks, left hand side, by creating CRR. By creating CRR out of free reserves. Right hand side, by issuing fresh shares. By issuing fresh shares. Now connect both. Connect left hand side and right hand side. Connect both and right, or combination of both. Combination of both. Below that, determination of number of shares to be issued. Determination of number of shares to be issued. Determination of number of shares to be issued. Scenario number one. Scenario number one, sufficient cash and free reserves. Sufficient cash and free reserves. Number of shares to be issued equals
Nil.
nil. Yes. Number of shares to be issued equals 0. Scenario number two. Scenario number two, sufficient cash sufficient free cash but insufficient free reserves. Sufficient cash plus but insufficient free reserve, within bracket use nominal value. Within brackets use nominal value. Below that, number of shares to be issued is computed. Number of shares to be issued is computed as under. Below that, nominal value of preference shares to be redeemed. Nominal value of preference shares to be redeemed less free reserves available to create CRR. Nominal value of preference shares to be redeemed less free reserves available to create CRR. Free reserves available to create CRR, that gives us the result is shortage. Right, shortage. Number of shares to be issued equals the above shortage divided by face value of shares to be issued. I'll repeat this if anyone got confused. Nominal value of preference shares to be redeemed less free reserves available to create CRR. Available to create CRR. This gives us the shortage. So number of shares is equal to shortage divided by face value of shares to be issued. Face value of shares to be issued. Done?
Yes, sir.
Yes. Scenario 3. Scenario 3. Sufficient free reserves, but insufficient bank balance. Sufficient free reserves, but insufficient bank balance. Below that, or within brackets, we say use
Issue price.
Issue price. Use issue price. Below that, amount required for redemption of preference shares. Amount required for redemption of preference shares divided by we're not dividing straight away. Less amount available for redemption. Amount available for redemption amount available for redemption. Again, this gives us the shortage. This gives us the shortage. Below that, number of shares is equal to
Shortage by issue. Shortage by issue.
Shortage by issue price.
shortage divided by issue price. Number of shares is equal to shortage divided by issue price. Clear with this?
Yes, sir.
Yes. Scenario 4. Scenario 4. When free reserves and cash balance are insufficient. When free reserves and cash balance are insufficient. Below that, number of shares to be issued is equal to number of shares to be issued is equal to scenario 2 or scenario 3, whichever is higher. Scenario 2 or scenario 3, whichever is higher. Completely below that. Completely below that. Securities premium heading. Securities premium. Under that, Section 52 of the Companies Act Section 52 of the Companies Act Section 62 of the Companies Act allows utilizing securities premium.
Section
52. Section 52 of the Companies Act allows utilization of securities premium towards premium payable for redemption of preference shares. Premium payable for redemption of preference shares. Premium payable on redemption of preference shares. However, for certain companies, which is required to comply with accounting standards specified under Section 133, which is required to comply with accounting standards required under specified under Section 133, such securities premium cannot be used. Such securities premium cannot be used.
Sir, after accounting standards.
Prescribed under Section 133. Accounting standards prescribed under Section 133. Such securities premium cannot be used. Such securities premium cannot be used. Full stop. Therefore, security cannot be used. Full stop. ICI study material considers all companies to fall under the category. All companies to fall under that category. Fall under that category. Therefore, while solving to write off the premium payable on redemption, to write off the premium payable on redemption, we shall not use securities premium. Rather, we use
free reserves.
We shall not use securities premium. Rather, we use free reserves. Clear?
Yes.
Yes. We are done with redemption of preference shares concept. Can we all move on to the questions? Any doubts in this? No.
Sir.
No, sir.
Here. Okay, fine. We'll move on to the concepts. Can we all come to page number with regard to redemption of preference shares? I think we can directly go to RTP question. Those questions which are there in the revision material, we have already solved in the class. So again, no need to look into those. So we can directly come to RTP questions. We have question number 7, 2 questions in RTP, May 23. First question number 7A. The board of directors of a company decided to issue minimum number of equity shares of ₹9 to redeem 250,000 preference shares. The maximum amount of divisible profits available for redemption is 150,000. Calculate the number of shares to be issued by the company to ensure that provisions of section 55 are not violated. Also determine the number of shares if the company decides to issue shares in multiples of ₹50 only. We'll come to the last part later. Also determine. First, calculate the number of shares to be issued. Go with those 4 scenarios and compute. So are we going with scenario 2 or scenario 3 or scenario 4? Scenario 4?
Scenario 2. Scenario 2.
Scenario 2. They have not given us bank balance at all. So we are presuming it to be sufficient. Even if it is insufficient, we do not know to what extent it is insufficient. So scenario 3 is ruled out. Therefore, it has to be scenario 2. What is the nominal value of preference shares to be redeemed?
250,000.
250,000.
Yeah, this is not number of shares, this is amount itself. So directly we can take 250,000. Less free reserves available.
150,000.
150,000. Divided by, the resultant we get 1 lakh is the shortage. This shortage should be divided by face value of the shares to be issued. What is the face value? Minimum number of equity shares of
9.
9.
Now, is this 9 rupees face value or issue price?
Face value.
Face value.
Yes, value.
Very good. It is face value because they are not telling at ₹9. They are telling of ₹9. Correct. Therefore, it is face value. 1 lakh divided by 9, we get the number of shares. We get 11,111. Yes, that's the number of shares that we get. Everyone.
So shouldn't it be 112?
112.
1111 or 1112. 4 ones, 5 ones or 4 ones and 2. That depends on the rounding off. Also determine the number of shares if the company decides to issue shares in multiples of ₹50 only.
Sir, 150. 11,150.
150.
11,150.
1,100.
11,100 or 11,150?
11,100.
150.
150.
Both are wrong. They are not telling in multiples of 50 shares only. They are telling in multiples of ₹50 only.
Is it 2,000 shares?
2,000 shares.
Yes, sir.
How?
1 lakh divided by ₹50.
Check once more. Naman, how did we get 223?
Sir, 11,112 by 50 rounded off to the nearest rupee.
why 11,112 divided by 50?
So that is the amount of free reserves we require. So I thought.
No.
$11,150.
How 11,150?
Sir, I have taken some trial and errors. So 11,150 into rupees 9 comes up to 1,350,000.
Okay.
So it's in rupees 50 multiples.
Rupees 50 multiples.
Yes, sir. And if I take any other number, then it's not. I mean, it will be in decimals or not in multiples of 50.
Okay. Now, what are they telling? If the company decides to issue shares in multiples of 50 only, multiples of rupees 50 only, that means
11,150 shares. Yes.
okay, ignore that. Ignore the answer. What does this sentence mean?
So it can be rupees 10 since it is multiple of 50.
In multiples of
Issue
50,
price is
Issue
we can
price
allot
is
shares at 50 rupees per share, 100 rupees per share, 150 per share, 200 per share, 250 per share. Correct? That is what it means.
Yes, sir.
But normally when we make an issue, the issue price will be fixed. Correct? So the question is wrong. It cannot be rupees 50. It should be 50. You were all right. It should be 11,150. Okay. So rupees cannot be there. It cannot be rupees, multiples of rupees 50. Multiples of rupees 50 means issue price can be variable. It can be fluctuating. And that cannot fluctuate 50 rupees per share. Definitely not, right? So it has to be multiples of 50 shares. So what we got was 11,112. We cannot issue 11,112 because it should be in multiples of 50. It should be either 11,100 or 11,150. If I go with 11,100 shares, then there will be shortage of 12 shares. So I have to go with the highest number, 11,150. Everyone understood?
Yes, sir.
Yes. So such questions can be asked. So this rupees is wrong. Okay, it should be 50. Printing error. Next question. Make Limited had 6,014% redeemable preference shares of rupees 100 each, fully paid up. The company had to redeem these shares at a premium of 10%. It was decided by the company to issue the following: 50,000 equity shares of rupees 10 each at par, 2,012% debentures of rupees 100 each. Issue was fully subscribed and all amounts were received in full. Payment were duly made. Company had sufficient profits. Show journal entries in the books of the company. Similar problem we had discussed earlier in the class. So first we will go with issue. Issue of equity shares, issue of debentures. Then they have to redeem. With regard to redemption, number of shares to redeem is 6,000 of 100 each at a premium of 10%. Now, should we create CRR in this case?
Oh, sir.
No, sir.
Why no?
Sufficient profits.
We
Insufficient.
have sufficient free reserves.
What? Why should we not create CRR?
So since we have
because equity shares are being issued.
Equity shares are being issued. So because equity shares are being issued, we discussed that the redemption of preference shares can happen out of creation of CRR or equity shares. So because equity shares are being issued, CRR need not be created. Correct? Everyone understanding?
Yes, sir.
Okay.
Yes, sir.
Yes. But Suviksha is not agreeing.
The combination of is the nominal value of preference share will not be sufficient, satisfied with the issue.
Yes, very good. See, even though we are issuing equity shares, we have to check whether we are compensating in full. What is the preference shares being redeemed? 6,000 into 100, 6 lakh nominal value. So share capital is decreasing by 6 lakh, but share capital is increasing only by 5 lakh. Yes, we are allotting debentures. By allotting debentures, will my share capital be compensated? No.
No.
So there is still a shortage of 1 lakh for which we have to create CRR. Clear with this? Yes. So
Yes,
using
sir.
this concept, we have to just pass journal entries. That's all. A simple question. So we have to allot equity shares, allot debentures, calculate the CRR to be created, pass journal entry, create CRR. Here there is no insufficient information given, insufficient free reserves, insufficient bank balance. So we need not worry about that. Just pass the journal entries. So if you want, we can look into the answer. If you look into the answer, first issue of equity shares, bank account debit to equity share capital 5 lakh. Bank account debit to 12% debentures, issue of debentures, both were at par. Then creation of CRR, P&L account debit to CRR, 1 lakh rupees. That difference that we got. Then due entry for redemption, 12% redeemable preference share capital account debit, premium on redemption of preference shares account debit to preference shareholders account. Then we have already created CRR. Then what was the third entry? Write-off of premium, P&L account debit to premium and redemption of preference shares. Last one, payment entry, preference shareholders account debit to bank account. That's these are the journal entries to be passed. I think we didn't write that particular point. Write down journal entries to be passed in case of redemption. Journal entries to be passed in case of redemption. Below that, entry number 1.
Due entry.
Very good. Due entry. Preference share capital account debit. Preference share capital account debit. Premium payable on preference shares account debit. Premium payable on redemption of preference shares account debit. Preference share capital account debit. Premium payable on redemption of preference share account debit to preference shareholders account. Yeah, to preference shareholders account. Entry number 2.
Preference shareholders account debit to bank account.
But generally we go with the flow. Even though suggested answer in that RTP, they specifically have given second entry as payment entry. We'll go with our flow. What was the second entry that we would generally pass? Creation of CRR.
CRR.
Creation of CRR. Creation of CRR, free reserves account debit to CRR account. Free reserves account debit to CRR account. Entry number 3. Entry number 3.
Write-off of premium.
Write-off of premium. Premium payable. Free reserves account debit to premium payable on redemption. Free reserves account debit to premium payable on redemption account. Last 4th entry. Payment entry. Payment entry. That is preference shareholders account debit to bank account. Is that clear? Yes. Any doubts in whatever we have discussed? Redemption of preference shares? No?
Sir.
Clear?
No, sir.
Clear. So we have discussed 3 chapters: pre-incorporation, post-incorporation profits, bonus issue, right issue, redemption of preference shares. Perfectly clear?
Yes, sir.
Yes. 2 more chapters left. We'll discuss about it. Before that, we take a break.
Thank you, sir.
Thank you, sir.
Take a break. We'll come back at 6:20. Okay, and then discuss 2 more chapters and wind up.
Yes, sir.
Yes, friends, are we all back?
Yes, sir.
Yes, sir.
Yes, sir.
Yes. Shall we start or shall we continue?
Yes, sir.
Yes, sir. Yes, sir.
Yes, sir.
Before continuing, where is the birthday boy? Yes, Naman. Happy birthday, man.
Thank you, sir.
Yeah, you are doing great.
Happy birthday, Naman.
Continue.
Happy birthday.
Happy
Naman.
birthday, Naman.
No, it is you have already wished. It's only my wish was pending. I'll wish him first.
Yes, sir.
Yeah, you're doing great. Just continue to do whatever you're doing. I wish you that you great success this year. Okay.
Thank you, sir.
Be the same way you are. Be active in the class. Today you are not active. I know why. Let's continue. Okay, fine. We'll move on to the next chapter. Which was the fourth chapter that we discussed?
Insurance claim.
Insurance claims.
Claims. In fact, two things in insurance claims.
Loss of stock
And loss of profit.
Loss of
Profits.
Loss of stock policy, loss of profit policy. Yes. In case of loss of stock policy, the ultimate objective was to calculate
Claim amount.
Closing
Yeah.
stock.
Stock loss.
both cases. In case of
After
loss of stock policy, the ultimate objective is to calculate closing stock. Yes, closing stock as on the date of fire. To calculate closing stock as on the date of fire, we will prepare memorandum trading account. In that, we want gross profit. So first, if the question gives us gross profit directly, gross profit percentage directly, we'll directly start with memorandum trading account. If the question doesn't give us, then we have to compute GP percentage. How? By preparing
trading account of the
Trading
previous year.
account of last year. So we prepare trading account of last year. There we will have opening stock, purchases, sales, closing stock. Gross profit is the balancing figure. Gross profit by sales into 100 will give us the GP percentage. But one thing that we have to keep in mind is
Abnormal items.
Normal item should be
yes, it
ignored.
should only be normal. Therefore, all abnormal items should be readjusted, should be reversed. Correct? So if there is a write-off in the stock, add back that write-off and then calculate GP percentage. Once we get that GP percentage, come to memorandum trading account. Whether it's a 1 column or 3 column depends upon whether such abnormal stock, if any, in the opening stock is sold during the year. If abnormal stock is sold during the year, then it'll be a 3 column memorandum trading account. Else it'll only be a single column memorandum trading account. If it's a 3 column memorandum trading account, so divide completely between normal, abnormal, and total. Normally, all purchases during the year should be normal. Correct? Sales, we will divide it between normal and abnormal depending upon the information given. Abnormal gross profit or loss, will it depend on the GP percentage of last year? No. Right? They themselves would have given us goods costing so and so is sold at so and so amount. So we get the gross profit or loss. Closing stock of abnormal will be valued based on the information given. If they say it will be valued at original cost, then we will value it original cost. Or if we say it will be valued at 50% of the cost, then accordingly we will value it. That's abnormal column. In case of normal column, as it is, whatever is being given, we will record. Normal sales into GP percentage will give us the gross profit. Thereby, closing stock is the balancing figure. So closing stock will be the balancing figure only in case of normal column. Correct? In case of 3 column memorandum. Obviously, in single column, it has to be the balancing figure in that column itself. Now, once we get the closing stock, now when we are calculating the claim amount to get the closing stock, should we consider normal column closing stock or total column closing stock?
Total column of closing stock.
It has to be total column because abnormal stock also would be damaged. Fire will not differentiate. Correct? It will damage all the stock. So it has to be total column closing stock. Now, this closing stock need not be our loss because there could be some salvage value. So loss will be closing stock minus salvage value. Once we get the loss, we have to check for
Average
average clause applicability. First, we have to check whether it's part of the contract or not. If the question specifically gives average clause is not part of the contract, we'll consider that. If question is silent, presumed to be part of the contract. Correct? Now, based on that, we have to check for applicability. To check for applicability, we check 2 things. One,
closing stock is
closing
more than
stock.
insured.
Insured amount.
Insured amount.
If closing stock is greater than or equal to insured amount or greater than insured amount, should
Average
it
class?
be greater than or
Average
greater than
class.
or equal to?
Greater
Greater than or equal to. Correct? If closing stock is greater than or equal to insured amount, then applicable or not?
Applicable.
Applicable.
So it should be greater than. Closing stock is greater than insured amount. Average clause is applicable. If closing stock is less than or equal to insured amount, average clause is not applicable. I'll repeat. If closing stock is greater than insured amount, average clause is applicable. Less than or equal to insured amount, average clause is not applicable. So if insured amount is 1 lakh, closing stock is also 1 lakh, obviously average clause need not be applied. What is the logic? Only if in case of under insurance, we apply average clause.
Average clause.
But it has to be greater than, not greater than or equal to. Clear?
Yes.
If average clause is applicable, then proportionately, that is actual loss divided by closing stock.
Closing stock
into
into insured amount.
If average clause is not applicable, loss itself will be the claim amount. Is that clear? That is
Yes.
loss of stock policy. Then we discussed about loss of
Profit.
profit policy. In case of loss of profit policy, we have two different categories. First one is, what is the first one? What's the first part? Loss of profit.
Profit loss.
Short sales.
Short sales. Very good. Profit loss due to short sales. How do we calculate profit loss due to short sales? First, we have to compute short sales. How do we calculate short sales? We have to first identify the sales that we had achieved during that period of disruption last year. To that, what we will do? Add or subtract the trend depending upon the question given in the question, data given in the question. That gives us the target sales minus actual sales achieved will give us the short sales. Correct?
Yes, sir.
Short sales into profit percentage will give us the profit loss. Here profit refers gross profit, but this is not that gross profit that we used in loss of stock policy. Here gross profit is
Net profit plus
Profit plus
charges.
very good. Net profit plus insured standing charges. Standing charges are fixed charges. Out of those fixed charges which are insured, part of the insurance contract will be insured standing charges. So net profit plus insured standing charges will give us gross profit. Again, if GP percentage is not given, then we have to apply this or calculate gross profit of last year. Net profit of last year plus insured standing charges of last year will give us gross profit of last year. Gross profit by sales into 100, GP percentage. GP percentage into short sales that we have already computed will give us the profit lost due to short sales. Is that clear?
Yes, sir.
Yes.
Yes,
So
sir.
that is profit loss due to short sales. Once we are done with that, we have to go to the second part. Before going to the second part, we have to calculate adjusted annual turnover. Adjusted annual turnover is turnover of how many months?
12
Months.
months.
Months
Including the date of-
preceding the date of hire. Correct. So from the date of hire, go back 12 months. That's the turnover. Here, one special point is this falls into different financial years. So adjustment of trend on which turnover. If they have given us the bifurcation, we will adjust the trend on those turnovers falling in the previous financial year or current financial year.
Previous
Financial.
Good. Previous financial year. Current financial year, as it is, we will consider. However, if bifurcation or breakup is not given,
On the entire period.
on the entire.
Entire turnover.
yes, either we can ignore or we can apply on the entire thing. Preferably go with applying to the entire turnover with a note. Correct? That gives us AAT, adjusted annual turnover. What we require is not AAT, we require GP on AAT. So gross profit on adjusted annual turnover is AAT into GP percentage. With this information, we can go with the second part of the discussion, which is
Allowable addition.
allowable additional expenses. Allowable additional expenses is just a simple formula, lower of 3, right? What were those 3? Actual additional expenses. Second,
Loss profit
GP on additional sales due to additional expenses.
gross profit on additional sales due to additional expenses, and the last one,
GP on AAT divided by GP on
Divided by GP on
AAT.
uninsured standing charges to actual additional expenses.
yes, GP on AAT divided by GP on AAT plus uninsured standing charges into actual additional expenses. Whichever is less will give us the allowable additional expense. Now here, the total losses, we have to add both profit loss due to short sales plus allowable additional expenses. From that, there we reduce salvage value. Here we are reducing
Savings on insured standing charges.
standing charges only. If they have given uninsured standing charges savings, ignore. Savings in insured standing charges only shall be reduced. This gives us actual loss. Once we have actual loss, same, we have to check for applicability of average clause. Here, for checking applicability, we will compare
GP on
AAT.
GP on AAT with the insured amount. If GP on AAT is greater than insured amount, applicable. If average clause is applicable, actual loss by GP on AAT into insured amount will give us the claim amount. If average clause is not applicable, then loss itself will be the claim amount. Is that clear?
Yes, sir.
Yes, sir.
Yes, that's it. This is what we have discussed in insurance claims chapter. Any doubts in this? No? Completely clear? Okay, write down. Insurance claims. Insurance claims. Below that, first one, loss of stock policy. Loss of stock policy. Step number one. Step number one, prepare trading account. Prepare trading account of last year. Prepare trading account of last year within brackets to compute gross profit percentage. To compute gross profit percentage. Hyphen. Here GP should be on normal sales. Here GP should be on normal sales. GP should be on normal sales. Step number two, find out gross profit percentage. Find out gross profit percentage. Below that, step number three, prepare memorandum trading account. Prepare memorandum trading account up to the date of fire. Up to the date of fire. Within brackets to compute
Closing stock.
Closing stock.
very good, to compute closing stock. To compute closing stock. Hyphen, if GP percentage is given, directly start from this step. If GP percentage is given, directly start from this step. Hyphen, if abnormal sales are made during the period, if abnormal sales are made during the period, then 3-column trading account. Then three-column trading account. Step number 4. Step number 4. Find out actual loss. Find out actual loss. That is equal to closing stock minus salvage value. Actual loss equal to closing stock minus salvage value. Then step number 5. Check for average clause applicability. Check for average clause applicability. 2 arrow marks. 2 arrow marks, left hand side. If average clause is part of the contract, right hand side, if average clause is not part of the contract. Below average clause not part of the contract. Below average clause not part of the contract. Claim is equal to actual loss or insured amount, whichever is
Yes.
less.
Yes.
Less.
Claim is equal to actual loss or insured amount, whichever is less. Right hand side, if average clause is part of the contract, 2 arrow marks. 2 arrow marks. If closing stock is greater than insured amount, if closing stock is greater than insured amount, average clause applicable.
Applicable.
Average clause applicable. Therefore, claim is equal to
Loss by
Loss divided by
Closing stock into insured amount.
to insured.
loss divided by closing stock into insured amount. Right hand side, if closing stock less than or equal to insured amount, then claim is equal to actual loss. Average clause is not applicable. Claim is equal to actual loss. Clear?
Yes, sir.
Yes. Next, loss of profit policy. Loss of profit policy. Below that, loss of profit policy. Below that, first one, computation of short sales. Computation of short sales. Below that, actual sales in the period of disruption, actual sales in the corresponding period to the period of disruption. I'll repeat, actual sales in the corresponding period to the period of disruption in the last year. In the last year. Less add or subtract, adjust, add or subtract for trend. That results in target sales.
Target sales.
Yes. From that, reduce actual sales. From that, reduce actual sales. Reduce actual sales. That gives us the short sales.
Short sales.
That gives us short sales. Step number 2, computation of gross profit percentage. Computation of GP percentage. Below that, GP is equal to
NP plus insured standing charges.
net profit plus insured standing charges. Net profit plus insured standing charges. Below that, GP percentage equals GP by sales into 100.
Short sales.
GP by sales into 100. Then step number
3.
Step number 3, compute profit lost on short sales. Compute profit lost on short sales, which is short sales into GP percentage. Short sales into GP percentage. Then step number 4, computation of adjusted annual turnover. AAT. Computation of adjusted annual turnover. Below that, turnover for a period of 12 months preceding the date of fire. Turnover for a period of 12 months preceding the date of fire. turnover for a period of 12 months preceding the date of fire. Below that, adjustment of trend 2 arrow marks. Adjustment of trend 2 arrow marks. Left hand side. If breakup between the financial years is given. If breakup between the financial years is given, then adjust the trend only to the turnover of
Previous period.
previous year. Adjust the trend only to the turnover which belongs to the previous year. Right hand side. If such breakup is not available.
Entire turnover.
Yes, applicable to the entire turnover. That is, trend shall be applied on the entire turnover with a note. Trend shall be applied on the entire turnover with a note. With a note. Below that, compute gross profit on adjusted annual turnover. Compute gross profit on adjusted annual turnover. Gross profit on adjusted annual turnover. Next, step number 5.
5.
Yes, step number 5. Allowable additional expenses. Step number 5. Allowable additional expenses. Below that, 3 arrow marks.
3 arrow marks.
3 arrow marks. Actual expenses. Actual additional expenses. Second,
Additional sales.
Profit on additional sales.
yes,
Into GP
additional
percentage.
sales due to additional expenses into GP percentage. Additional sales due to additional expenses into GP percentage. Last arrow mark, GP on AAT divided by GP on AAT plus uninsured standing charges into additional expenses. GP on AAT divided by GP on AAT plus uninsured standing charges into additional expenses. Whichever is
Lesser.
lesser. Whichever is the least. Okay, next. Step number 6. Step number 6. Actual loss. Computation of actual loss.
Profit loss due to short sales.
Profit loss due to short sales. Profit loss due to short sales. Add allowable additional expenses.
Plus savings in insured standing charges.
Allowable additional expenses less savings in insured standing charges. Less savings in insured standing charges. Done?
Just a minute.
Step number
Can you
7.
repeat actual loss?
Actual loss, profit loss due to short sales, add allowable additional expenses, less savings in insured standing charges. Step number 7, average clause.
Average clause.
Step number 7, average clause, 2 arrow marks.
Part of contract, not part of contract.
Average clause, part of the contract. Average clause, not part of the contract. Average clause, part of the contract. Average clause, not part of the contract. Below average clause, not part of the contract, claim is equal to actual loss or insured amount, whichever is lesser. Yes. Actual loss or insured amount, whichever is less. Right side. We have written on the right side, left side, where average clause is part of the contract. Below that, 2 arrow marks. 2 arrow marks. if GP on AAT is greater than insured amount,
Actual GP on AAT into insured amount.
if GP on AAT is greater than insured amount, average clause is applicable. Average clause is applicable. Therefore, claim is equal to,
Actual loss by GP on AAT into insured amount.
yes, therefore claim is equal to actual loss divided by GP on AAT into insured amount. Actual loss by GP on AAT into insured amount.
GP less than.
Right side, if GP on AAT is less than or equal to insured amount.
Claim is equal to actual loss.
If actual loss GP on AAT is less than or equal to insured amount, then average clause is not applicable. Claim is equal to actual loss. Done?
Yes, sir.
Yes. So we have completely looked in detail with regard to this chapter. Come to the material. We'll first look into RTP question. I think it was question number 10. Yes. A fire occurred in the premises of Messrs. Star and Sons on 21st March 2022. The concern had taken insurance policy of rupees 75,000, which was subject to average clause. From the books of account, the following particulars are available relating to the period 1st of April 21 to 21st March 2022. Stock as on 1st of April 21. Purchases, including purchase of rupees 40,000 for which purchase invoices had not been received from suppliers, though goods have been received in the godown. Cost of goods distributed as samples for advertisement from 1st of April 21 to the date of fire included in the above purchases. Sales, excluding goods sold on approval basis having sale value 35,000. Approval has been received for goods before the date of fire. Purchase return, wages, including salary of manager rupees 10,000. Average rate of gross profit at 20% on sale. Cost of goods salvaged. You're required to calculate the amount of claim to be lodged to insurance company. Is it loss of stock or loss of profit? Or both?
Stock.
Stock. Yes, it is loss of stock policy. Have they given us GP percentage?
Yes.
Yes. So we can directly start with memorandum trading account, correct? In memorandum trading account, they have the opening stock, purchases. Now, what should I do with this 40,000? Subtract or add?
Add.
Everyone?
Yes, sir.
Yes, sir.
Yes, everyone add
No,
40,000.
sir.
Sir, not
included.
received.
No, sir. Nothing. I don't think anything
Nothing
needs
to
to be.
do. Yes.
No.
Just because they have given an adjustment, it is not guaranteed that we have to add or subtract. Right? What have they given us? This 40,000 invoice is not received, but goods is received. It is included in the purchases. It is already included in the purchases. It should have been included. Correctly done. Nothing to do. Correct? So nothing to do with regard to this 40,000. Then what should we do with this? Add, subtract, nothing to do.
Less, sir.
Less.
Less from
We
purchase.
have to subtract because this goods is moved out of the entity as advertisement. So reduce from purchases. Then sales 4,55,000. What should I do with this adjustment?
Add back 35,000. Since
Add
it
it to
is
sales.
The option we have to take option.
Option. So either we can add it to sales or we can show it as
Goods like
with
stock
sale on
like
approval basis. Yes. And if we can show it at cost, correct?
yes, sir.
Everyone agreed? Understanding?
Yes, sir.
Yes, we have
It
solved
won't
similar.
appear in the credit side only.
We have to show it on the credit side of the trading account, correct?
Sir, I think so. We have to add it because approval has been received for goods before the date of fire.
Very good. Yes. So this is the point that we have to consider. Now, point number 1, normally in the questions that we have solved or that we have seen, sales including goods on approval basis. That is what they were giving. Here it is excluding. So this 455 doesn't include sales goods sent on approval basis. But when approval has been received, what we are doing? We have to recognize it as sales.
Yes, sir.
Since they have told the entire goods for which approval has been received, entire 35,000 is our sales. So add it to sales. Everyone understood?
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes. So it's the same adjustments that we have done, but given in a different way. We are getting confused. Purchase return.
Plus.
Add.
Decrease from
Deduct
Add
from
it
purchase.
to
Deduct from purchase.
Deduct.
purchase returns should be reduced from purchases. Net purchase.
Yes, sir.
Wages, including salary of manager, 10,000.
Salary of
Deduct
manager reduce.
Manager.
Yes, salary of manager should be reduced because it's indirect expense. Direct expense wages should be considered only 55,000. Then cost of goods salvaged, that is anyhow after closing stock. So this is given. We have sales into 20%. We get the gross profit. Thereby closing stock will be the balancing figure. This is single column memorandum trading account. Everyone.
Yes, sir.
Yes. So from that closing stock, reduce 12,000. You get the loss amount. Okay. So from that, we need to check whether average clause is applicable or not, and accordingly calculate the claim amount. Clear?
Yes, sir.
Yes.
Yes.
Everyone understood?
Yes, sir.
Yes. This was the question that was asked in RTP. We'll come back to the material. Come to page number, PDF page number 453. Page number 445, the material page number. Question number 1. Premises of Anmol Limited caught fire on 22nd January 14 and the stock was damaged. Firm makes account up to 31st March each year. On 31st March 2013, the stock at cost was 6,63,600 as against 4,81,100 on 31st March 2012. They've given us opening stock and closing stock. Simple. Then purchases from 1st of April 2013 to the date of fire were 1741,350 as against 22,62,500 for full year 12-13. Corresponding sales figure are 24,58,500 and 26 lakh respectively. You are given the following further information. In July 13, goods costing 50,000 were given away for advertising purpose. No entries being made in the books. During 13-14, a clerk had misappropriated unrecorded cash sales. It is estimated that the defalcation averaged 1,000 per week from 1st of April 2013 until the clerk was dismissed on 18th of August 2013. Rate of gross profit is constant. From the above, calculate the stock in hand on the date of fire. So first, do we have to prepare trading account of last year?
Yes, sir.
Yes,
We
sir.
have to prepare a trading account because they have not given us gross profit, and one more indication, they have given us sales and purchases of last year. So
Yes.
we prepare the trading account of last year. They have given us the opening stock, purchases, sales, closing stock is also given. Gross profit is available. So 20% is the GP percentage, easy. In memorandum trading account, closing stock of last year will be the opening stock, right? Then purchases is given. Purchases, 1741,350. Sales 2458,500. Correct? 1741,350, 2458,500. Now to that, there are some adjustments. 50,000 advertisement expenses, July 13. The advertisement purpose, given stock is given away. That should be
Reduced from
reduced from purchases. So purchases would be reduced to the extent of 50,000. Now what happens to this misappropriation of cash sales?
abnormal loss.
Abnormal loss. So what do we do?
In the credit side.
On the credit side?
By
Sir,
abnormal.
those cash sales have not been recorded. So the goods have already gone out. So we have to add.
We have to add where?
Sales.
To the sales.
Very good. Very good. Same logic. Purchases we had made the purchase, but goods is not received, invoice is received, we will not include in the purchases. We have made the purchase, invoice is not received, but goods is received, we will include in the purchase. Same way, sales. Sales is not made, but goods sent out, we will consider it as sales. Sales made, but goods not sent out, we will not consider it as sales. Correct? That is what we have learned in insurance. The idea is to ensure that closing stock represents the correct value. So in this case, goods have moved out, not recorded as sales. So we have to consider it as sales to ensure that closing stock is removed from the books. So what is the amount of sales that we will record? They say 1,000 per week.
calculate the number of weeks from 1st April to 18th August.
Very good. 1st April to 18th August, number of days we will compute. So the April, May, June, July, and August.
So 7 weeks.
122 plus 18 is 140. Correct? 140 divided by 7.
20.
20 weeks.
6 into 1000.
Correct? 20 weeks. We get 20 weeks. 20 weeks into 1000, 20,000.
20,000.
And therefore 20,000 would be added to 6. Is that clear?
Yes.
Yes.
Yes, sir.
Yes, sir.
If we do this, we know the gross profit percentage 2478,500 into 20%, 495,700. You'll get the closing stock as the balancing figure. So once you get the closing stock as balancing figure, check whether there is any salvage value. I don't think so. They have given salvage value. No, they have not given salvage value. So that itself will be the loss amount, 3,72,150. They have not asked us to calculate claim. They have only asked us to calculate stock in hand as on the date of fire. So that itself, the closing stock itself will be the final answer. Is that clear?
So what
Yes,
is
sir.
the defalcation, sir?
Defalcation is what? Misappropriation. Total amount of loss. Defalcation.
Yes, sir.
Fraud, the total amount of fraud. Next, we'll look into one loss of profit policy question. X Limited has insured itself under a loss of profit policy for 3,63,000. Indemnity period under the period policy 6 months. 1st of September 2010, fire occurred in the factory of X Limited and the normal business was affected up to 1st of March 2011. Following information is compiled for the year ended 31st of March 2010. Sales 20 lakh, insured standing charges 2,40,000, uninsured standing charges 20,000, net profit 1,20,000. Further, following details of turnover are furnished. Turnover during the period of 12 months ending on the date of fire was 22 lakh. During the period of interruption was 2,25,000. Actual turnover during the period from 1st of September 2009 to 1st of March 2010 during the preceding year, corresponding to the indemnity period, was 7,50,000. X Limited spent an amount of rupees 40,000 as additional cost of working during the indemnity period. On account of this additional expenditure, there was a saving of 15,000 in insured standing charges during the period of indemnity. Reduced turnover avoided was 1 lakh rupees. That is, but for this expenditure, turnover after the date of fire would have been only 1,25,000. A special clause in the policy stipulates that owing to the reason acceptable to the insurer under the special circumstances, following increases are to be made. Increase in turnover standard and actual by 10%. Increase in rate of gross profit by 2% from the previous level. You are required to calculate claim. So similar problem we have solved in the class. So short sales, how do we calculate short sales? First, identify the sales of last year, same period.
7,50,000.
7,50,000. What is the trend that I have to adjust?
10.
10.
Yes, in the
10%.
adjustment that given. Yes, I'll come to that. 10%, correct? 10%. So 7,50,000 plus 10%, you get 8,25,000 minus actual sales 2,25,000. So short sales 6 lakh. Now into gross profit percentage. What is the gross profit percentage that we have?
%.
Correct. Net profit 1,20,000. Insured standing charges 2,40,000. You get 3,60,000 divided by sales into 100. This is 18%. Everyone. With to this, there is one adjustment that we have to do. What?
2% increase.
Add 2%. So gross profit will be 20%. So short sales 6 lakh into 20%, 1,20,000 profit loss due to short sales. Easy. Then AAT have they given us?
Yes, sir.
Which is
22 lakh.
22 lakh. To this, we will adjust 10%. Entire, since there is no breakup given. 22 lakh plus 10%, 24 lakh 20,000 is the adjusted annual turnover into 20% will give us GP on AAT. 24 lakh 20,000 into 20% will be
4,84,000.
4,84,000. Yes, GP on AAT is 4,84,000. Then we will compute actual expense, allowable additional expense. They have given us actual additional expense of 40,000. What would be the second arrow mark? Profit loss, profit due to additional sales.
18,000.
18,000.
20,000.
20,000. 1 lakh is the additional sales that we have achieved into profit, 20%.
Yes.
So 20,000. Then gross profit on adjusted annual turnover is 4,84,000 divided by 4,84,000. What is uninsured standing charges? 20,000 into actual expenses 40,000. So this comes up to
8,430.
38,430.
430.
413.
413.
Okay. 38,413. So 38,413. Therefore, what is the allowable additional expense?
20,000.
20,000. Now, when we calculate the claim, we got profit loss due to short sales as 1,20,000. Then allowable additional expense 20,000. Is there any savings in insured standing charges?
15,000.
15,000.
Here 15,000. So 1 lakh.
1,25,000.
25,000 is the loss. They are not asking us the loss, they are asking us the claim. Now, GP on A8 is 4,84,000. What was the insured amount? 3,63,000. Tell me whether average class is applicable.
Applicable. Yes.
It is applicable because in GP on A8 4,84,000 is greater than the insured amount. Since average class is applicable, loss which is 1,25,000 divided by GP on A80 4,84,000 into 3,63,000 will give us the claim, which is
93,750.
93,750.
83,750.
everyone clear?
Yes.
Yes, sir.
Yes.
Yes, sir.
This is how we need to apply the concept in solving the problems. Everyone clear? Any doubts in this? No? Fine then. Can we move on to the last chapter?
Yes, sir.
Yes, sir.
Yeah, the last chapter that we have is departmental accounts. Right? In case of departmental accounts, we have discussed two types of departments: independent departments, dependent departments, based on who maintains the books of account. Correct?
Yes, sir.
No, sir.
No,
That's
sir. No,
branches.
sir.
Branch,
That
sir.
is
That is
department.
branch, sir.
No, based on whether that department depends upon the input from the other department. Transfer of goods. Right? Whether transfer of goods happen between the departments or not. If transfer of goods happen, then we call it dependent departments, else independent departments. Correct? Yes.
Yes,
In
sir.
case of dependent departments, since the transfer happens, the question is at what price the transfer happens. If the transfer happens at cost, then there will be unrealized profit in the other department at the end of the year. Correct?
Oh,
Sir.
If transfer happens at cost,
Unrealized
no concept of unrealized profit. Only if it is at above than cost, over and above than cost, then only we will have unrealized profit. Such unrealized profit computed should be reversed in
Central
P&L account.
yes. So here the main focus will be interdepartmental profits, the unrealized profits, stock reserve creation, so that elimination of that unrealized profit. So how do we compute the unrealized profit? Transfer price of the unsold stock, that is the closing stock available, into profit percentage included. Correct? That is how. If it is selling price, then 110 divided by 110. If it's cost plus 10%, accordingly we will calculate the unrealized profit. That is one part. One type of questions that can be asked. The other type is easy: allocation of expenses. Allocation of expenses will be based on some equitable basis. They would have given us those equitable basis. We need to identify which basis to be applied for what expenses, and accordingly we need to allocate the expenses and find out the profit. Clear?
Sir.
Yes, sir.
Yes. Apart from that, nothing much is there. There is one concept of memorandum stock and memorandum markup account in departmental accounts. Correct? In memorandum stock and markup account, memorandum stock account will always be at invoice price. Opening stock, goods received by the department, goods returned, then closing stock, sales obviously will be at invoice price, closing stock as well. However, all these loadings will be reversed in markup account. Correct? If there is any markdown, such markdown also will be recorded in both the accounts. If there is a goods lost, etc., that also will be recorded. With this, memorandum stock account will have some balancing figure. Such balancing figure will be transferred to markup account. After all the adjustments, markup account will give us the profit or loss of that department. Is that clear?
Yes, sir.
Yes, sir.
Yes, right up. Departmental accounts. departmental accounts. First part, serial number 1. Questions related to allocation of expenses. Questions related to allocation of expenses. Below that, prepare departmental trading accounts, trading P&L accounts. Prepare departmental trading P&L accounts in columnar format, or prepare a statement of allocation of expenses. It can be a statement of allocation also. Statement of allocation of expenses by allocating the expenses among departments. By allocating the expenses of departments, how?
Equitable basis.
Equitable ground.
Based on some equitable basis. Allocating the expenses of department based on some equitable basis. Next. Second, serial number 2. Serial number 2, questions related to unrealized profit. Questions related to unrealized profit. Below that, applies only to dependent departments. Applies only to dependent departments. Then, below that, unrealized profit results due to the closing stock. Results due to the closing stock lying in the second department. Which was transferred by the first department. At profits. Which was transferred by the first department at profits. Below that, stock reserve or unrealized profit is equal to stock reserve or unrealized profit is equal to transfer price of unsold stock. Transfer price of unsold stock into transfer price of unsold stock into profit included in the transfer price. Profit included in the transfer price whole divided by transfer price. Profit included in the transfer price whole divided by transfer price. Below that, completely below that, such unrealized profit shall be reversed in
P&L.
general P&L.
P&L.
Yeah, shall be reversed in general P&L account. Next sentence, next heading, serial number 3. Concept of memorandum accounts. Memorandum accounts. Below that, here 2 ledgers are prepared. Memorandum stock account and memorandum markup account. Memorandum stock account and memorandum markup account. Full stop. In memorandum stock account, all the transactions are recorded. All the transactions are recorded within brackets, opening and closing stocks, goods received from the other departments, purchases, goods lost, etc. Close the brackets. All the transactions are recorded within brackets, whatever we have written, close the brackets, at
Invoice price.
yes, at
Invoice.
invoice price. At invoice price. Full stop. Corresponding profit element within brackets loading. Corresponding profit element within brackets loading.
Transfer to memorandum markup account.
Yes, shall be reversed in the memorandum markup account. Shall be reversed in the memorandum markup account. Shall be reversed in the memorandum markup account. Clear? If there is any markdown during the year, if there is any markdown during the year, shall be recorded in both the ledgers. Shall be recorded in both the ledgers. Recorded in both the ledgers. Full stop. If such markdown stock, if such markdown stock is part of closing stock, if such markdown stock is part of closing stock, then the stock reserve or unrealized profit, then such stock reserve or unrealized profit shall be computed by considering such markdown. By considering such markdown. Hope everyone understood. If
Yes,
you
sir.
remember that
Sir.
memorandum markup account that we had prepared of silk department, right? We had added the markdown, then applied the percentage, got the closing balance, subtract that markdown again at the end. Correct? So we have to consider such markdown while computing the unrealized profit or closing stock. Clear?
Yes, sir.
Yes. We'll look into some of the questions. Before that, any doubts? Question number 12, yes, is departmental accounts. The following balances were extracted from the books of Beta. You are required to prepare a departmental trading account and general P&L account for the year ended 31st March 2022. Department A and B, they have given opening stock, purchases and sales. General expenses incurred for both the departments were 7,50,000 and you are also supplied with the following information. Closing stock of Department A rupees 6 lakh, including goods from Department B for 1,20,000 at cost to Department A. Closing stock of Department B rupees 12 lakh, including goods from Department A for 1,80,000 at cost to Department B. Opening stock of Department A and Department B include goods of value of 60,000 and 90,000 taken from Department B and A respectively at cost to transferee departments. Gross profit is uniform from year to year. We have to prepare departmental trading account and general P&L account. So we'll look into the answer. Really easy. First, we'll prepare department trading account. In general P&L, this 7,50,000 will be part of the general expenses, correct?
Yes, sir.
Yes. So in departmental trading account, opening stock, purchases, sales, closing stock, gross profit. Simple. That is straightforward. No adjustments there. So this gross profit, what do? We transfer to general P&L account. In general P&L account, we'll bring the gross profit, then general expenses. Now, what about the stock reserve? How do we compute the stock reserve? How do we compute the stock reserve? In that question, I'll go back to the question if required. Page number, I think 12. No. Yes. they have given us 1,20,000 in department B. No, department A, and 1,80,000 in department B. Closing. Same way we have opening. So how do you calculate the stock reserve?
So we have calculated the gross profit
Correct.
in the trading account.
Correct.
So with the help of that, we will be computing the gross profit percentage.
Correct.
And if we apply those to this, so gross profit of department A to the stocks of department B, and gross profit of department B to the stocks of department A,
Correct.
then we will get the closing and opening reserves.
Correct.
It should be posted to the respective sites of the general.
Yeah, we can either post it to respective sites, or we can also calculate net.
Net.
Correct.
Yes.
Both are permissible. So that is how it is computed. So if you look into, you first calculate gross profit. How? Gross profit by sales into 100, gross profit by sales into 100. Gross profit of department A is 40,000, department B is 50%, 40% and 50%. Opening, they have said department A has 60,000. Department
Yes.
A has 60,000 or department B had 60,000?
A has 60,000, B has
Yeah,
20,000.
Department A include goods of value of 60,000, correct? Department B include goods of value of 90,000. Yes. So if you look into department A's opening stock, 60,000 of department B. Should I apply 40% or 50%?
50%.
Why? Because this is of department B's stock. So I will apply 50%. 60,000 into 50%, 30,000. Same way, department B had 90,000. Now this includes goods of department A, which has 40%. So 90,000 into 40%, 36,000. Everyone understanding?
Yes, sir.
Yes. Closing stock reserves, same way, 1,20,000 into 50%, 1,80,000 into 40%. This unrealized profits, opening stock reversed in the P&L account, closing stock debited to the P&L account. Alternatively, we can also record the net figure. Closing minus opening. The net figure can be debited to the closing stock. With that, we get the net profit. Write down. Example. Gross profit percentage of department A is 40%. Gross profit of department B, 50%. Then below that, closing stock of department A, includes rupees 1,20,000 worth of goods received from department B. $1,20,000 worth of goods received from department B. Second, closing stock of department B includes rupees 1,80,000 worth of goods received from department A. Next, opening stock of department A includes rupees 60,000 from department B. And opening stock of department B includes 90,000 from department A. Done with the question? Yes? Okay. Now, before moving on to the answer, the point that we might have confused is this word. Question says cost, but why are we computing stock reserve? Here, closing stock of department A includes goods for 1,20,000 at cost to department A. Department B has sent goods to department A. This is cost to department A. They're not telling cost to department B. Right? They're not telling it was transferred at cost. No, it is recorded at cost to department A. That is what they are telling. Therefore, that doesn't mean that there is no unrealized profit. And why should we calculate unrealized profit? Is because of this point. They have specifically given a hint that you have to calculate unrealized profit by stating that gross profit is uniform throughout the year. Use that gross profit as a margin to calculate unrealized profit. Okay, now we will compute unrealized profit for that. So, department A, department B, opening stock, closing stock. Department A opening stock was 60,000. Correct?
Yes, sir.
Now this 60,000 belongs to department B. Department B would have transferred it at cost plus its profit. Its profit is gross profit is 50%. So unrealized profit included in this is 50%. Gross profit is percentage on sales. So 60,000 into 50%, 30,000. Same way, department B opening stock 90,000. This was received from department A. Gross profit is 40%. So unrealized profit included here is 40%, which is 36,000. Same way, closing stock. Department A was 1,20,000 into gross profit percentage. 50%.
50%.
Therefore, 60,000. Closing stock 1,80,000 into 40%, 72,000. So add up opening stock reserve 66,000, closing stock reserve 1,32,000.
So GP percentages on sales, no sir.
Correct. These are all sale values only, no? The 60,000 represents the transfer price of department B. Department B's sale price.
Then it should be 50 by 150, no sir.
No. See, if it was cost plus 50%, then whatever you are telling is right. This is what? This is sales into 50%. Gross profit formula is GP by sales into 100. Percentage on sales. This is the sale value. Percentage on sale, 50% on sale, 60,000 into 50%.
Got it, sir.
Yeah. Yes, Rangaru.
So what we learned is actually the when we are closing the books of account, that is the time actually which we'll have to remove the unrealized profits. That is on the closing stock.
Correct.
So in this case, actually, we are removing from the opening stock also.
Not necessarily. We are not removing on the opening stock. Basically, we are reversing whatever we have recognized in the last year. I'll explain that in the next sentence. Okay, write down. Write down. Here, rupees 66,000, which was unrealized profit of the last year, shall be reversed in the current year, by crediting P&L account. By crediting P&L account. And rupees 1,32,000. Rupees 1,32,000, which is unrealized profit of current year. Unrealized profit of current year shall be recognized during the year by debiting P&L account. Shall be recognized during the year by debiting P&L account.
Sorry, sir, I couldn't hear the last bit. I'm having network.
1,32,000.
Yes, sir.
Unrealized profit of 1,32,000 shall be recognized in the current year by debiting P&L account.
Thank you, sir.
by debiting P&L account. Clear?
So why we are debiting to P&L account, we will be moving to stock reserves, no?
Correct. Stock reserve. What would be the journal entry that we have to pass? P&L account debit to stock reserve account.
No, actually, we did stock reserve account debit to closing stock, no? To remove the
No, that's the presentation that happens in balance sheet. Priyanka. Yes, that's the presentation that happens in balance sheet. In balance sheet, in current assets, you will have stock minus stock reserve.
stock reserve.
The corresponding effect, where do we give? It should be reduction in profit. Why? Because profit is higher because closing stock is valued at higher price. Profit is higher. How do you reduce the profit? By debiting the P&L.
Okay.
Okay. Below that, write down alternatively, we can recognize only the incremental stock reserve, or unrealized profit. Incremental stock reserve or unrealized profit in the current year's P&L account. In the current year's P&L account, that is next line, current year, or rather closing unrealized profit, 1,32,000. Closing unrealized profit 1,32,000 less opening unrealized profit. Unrealized profit 66,000. Opening unrealized profit 66,000. Net 66,000. This shall be debited to P&L account. So instead of crediting 66, debiting 132, we can just debit 66. That can also be done. Everyone understood?
Yes, sir.
Yes, sir.
Yes, that's it. This was the RTP question that we had. We'll look into one more question. Come to the material. Page number 522. That is 514 in the material. 522 PDF. This is markup markdown. This we have discussed, which we have already discussed. So similar problem, look into it. Martis Limited has several departments. Goods supplied to such department are debited to memorandum stock account at cost. I think this is the same question that we have discussed in the class, one of the examination question. Okay, one of the examination questions. So look into this. We will discuss this question. If Limited has 3 departments and submits the following information for the year ending 31st March 2014. L, M, and N are the 3 departments. Purchase units, purchase amounts, sale units, selling price per unit, and closing stock. We have to prepare a departmental trading account if Limited, assuming that assuming that rate of profit on sale is uniform in each case. Very important point. Rate of profit on sale is uniform in each case. That is, gross profit is uniform in each case. In each case, it is uniform. So how do we prepare the trading account? They have given us units, but purchase they have not given per unit. They have given us total. That apportionment is important. Sales is easy. We have given a sale unit, sale per unit. We can calculate total sales of that department easily. So total sales 12,240 into 40, 23,040 into 45, 29,952 into 50. We'll get that. Opening stock, I don't think so they have given us, right? I think question is incomplete. Opening stock should be given. Directly, it should have been given. Purchases, how do we bifurcate this? How do we bifurcate this 12 lakh? Omkar? Tell, it's okay. Fine. So based on, first we have to compute the profit margin. Okay. So if you look into the answer, now what have they given us? They have given us the purchases. Correct? They have given us the purchase units. If I multiply the selling price per unit, 12,000 into 40, 24,000 into 45, 28,800 into 50. This is not sales. This is purchases into selling price. I'm not multiplying sale units into selling price, purchase unit into selling price. So this gives us total selling price of 30 lakh, whereas purchase is 12 lakh. Now, these units, if sold, will fetch us 30 lakh. These units which we have purchased, if sold, will fetch us 30 lakh, whose purchase cost is 12 lakh. That means profit is 18 lakh, gross profit. So gross profit divided by sale into 100, 60%. They have told that rate of profit is uniform in each case. So profit of department L is 60%, department M is 60%, department N is 60%. Everyone understood?
Yes.
Yes, sir.
Yes, sir.
So how did we arrive at this? I considered if this purchase units were sold, that would fetch me 12,000 into 40, 24,000 into 45, 28,800 into 50, adds up to 30 lakh. Their purchase cost were 12 lakh. So profit of 18 lakh. 18 by 30, 60%. Since they have given rate of profit is uniform, 60% is the gross profit percentage of each department. Based on that, if selling price is 40 rupees, gross profit would be 40 rupees into 60%, 24 rupees. Correct? Per unit of department L, if selling price is 40 rupees, then gross profit will be 40 into 60%, which is 24. That means purchase cost is 16 rupees.
Yes, sir.
40 minus
Yes,
24. So 16 rupees into 12,000. If we do, how much do we get?
1,92,000.
1,92,000. Same way, 45 into, directly I'll take 40% is the purchase. 60% is gross profit, means 40% purchase. 45 rupees into 40%, how much do we get?
18 rupees.
18 into 24,000.
4,32,000.
Same way, 50 into 40 is 20. 20 into 28,800, 5,76,000. Everyone understood how did we get purchases?
Yes, sir.
Yes. So we have sales, we have purchases. Now, how do you value this closing stock?
Sir, actually, we can compute opening stock.
Yeah, we can also compute the opening stock as well. Correct. You're right. Because they have given us closing stock units, sales units, purchase units. Can we calculate opening stock?
Units, yes,
Yes,
yes.
sir.
Yes, opening stock units into purchase price that we have computed now. 16 rupees, 18 rupees, 20 rupees. Same way into 12,200 into 16, 1,920 into 18, 72 into 20 will give us the closing stock value. Okay. This is a good question. All information is given.
Closing stock may be balancing figure information.
Everything is inherent. Everything is implicit, which we need to find out. Yes, Pradeep?
Closing stock may be balancing figure. So
No, cannot be. Could be the balancing figure also, because we know the gross profit percentage. You're right. Yes, that cannot.
Even if we calculate closing stock on the basis of purchase price into closing stock units,
Yes.
and calculate gross profit on the percentage of sales, it will
We should
still
get the same answer. It should tally. Yes, you should get the same answer. Yes, you're right. Everyone understood this?
Yes, sir.
Yes, sir.
Yes, sir.
Yes, sir.
Okay, right.
Sir,
So, yes, Varshini, tell me.
can you just say what does that uniform in each year hint?
Simple. See, rate of profit on sales is uniform in each case. That means gross profit percentage of each department is the same. If gross profit percentage of each department is the same, the total gross profit will also be the same. Gross profit in the sense gross profit percentage, obviously not the amount, gross profit percentage. So if I find out the GP percentage of the total, I can say that GP percentage of LMN is the same GP percentage.
Yes, sir.
Yes, using that only we can proceed with the solution. Okay, fine. So with that, we have discussed 5 chapters, right? Branch accounts. Anyhow, we are yet to complete. Once we complete, maybe in the next round of revision, we'll consider that as well, branch accounts as well. Now, for every chapter, some concept notes that you have written, right? That is what you will refer the day before the exam. That's all. The entire concept is given in that notes, right? So it could be day before the exam or any test that happens. You have to just refer that covers the entire concept, right? Just solve some problems. This revision material has lots of problems. If you have seen the material, it's more than 600 pages.
Yes.
right? So your job starts to complete entire 600 pages. Everything should be in your head, not in the book. Okay, fine. Solve some problems, solve some more problems. So what you have to do is, while you are preparing, just read the concepts, whatever the notes that we have discussed, just read the concepts and solve the problems. Not how Madhumita is saying, I'm telling, not on the head, inside the head. The notes should be, the concepts or problems should be inside the head. Yes, not above the head. Okay, fine. So solve some more problems. When you're solving the problems, just refer the revision material. Whatever revision material problems are there, how revision material contains some good standard problems. Apart from that, examination problems, RTP questions. So it's a compilation. So that makes your job easy. You need not refer multiple materials, multiple RTPs, multiple suggested answers. Everything is compiled in that material itself. So it will be easy. So just refer to those. All types of questions would be covered. So any question that can be asked in the exam, definitely you will be prepared to solve it. Clear?
Yes, sir.
Yes.
sir.
Doubts,
Yes, sir.
doubts in whatever we have discussed today?
No, sir.
No, sir.
No. Okay, fine then. So prepare, read on it, read extensively. Now, obviously, we have no option since one first group accounts is completely done, even revision, including revision. Obviously, the other two subjects also, law and costing revision is also done.
Yes, sir.
Even taxation also, I think it should be done.
Yes, sir.
Yes,
Done,
sir,
sir.
taxation.
So by now you should be experts in group 1. That is the expectation. If you are not, start preparing. Okay, prepare. Don't pressurize. Just put in your efforts. Just focus on your preparations. Don't waste time. Whatever time is available, focus on your preparations. It's just a matter of 4.5 more months. That's all, right? After that, who will ask you to read? No one. Even if we ask, we will not read, obviously. So read, put your complete efforts in the next 4.5 months. Definitely it will happen. Thank you.
Yes, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you,